From the library of the New York Stock Exchange at the corner of Wall and Broad Streets in New York City, you're inside the Ice House, our podcast from Intercontinental Exchange on markets, leadership, and vision in global business. The dream drivers that have made the NYSE an indispensable institution of global growth for over 225 years. Each week, we feature stories of those who hatch plans, create jobs, and harness the engine of capitalism. Right here, right now at the NYSE and at ICE's exchanges and clearinghouses around the world. And now welcome inside the Ice House. Here's your host, Josh King of Intercontinental Exchange.
Out for a walk the other day, I looked up at Black Dome, the highest peak in the Blackhead Mountains range of the Catskills, inspiration for Thomas Cole and so many members of the Hudson River School realists. They would have enjoyed these quiet, mostly car-free days in 2020. Can't be too much different from 1820, a couple of years after Cole emigrated to the United States. We see, like they did, leaves returning and spring flowers at the cusp of bloom. It reminds us of the power of nature, the possibilities that life has to offer. It's one of my favorite times of year. But seasons and weather patterns aren't always as pleasant. I'm mindful that even amid the pandemic, 80,000 people remain without power in Nashville more than 2 months after the March 3rd tornado that killed 25 people. And if that wasn't bad enough, looking at the calendar, June 1st marks the start of the hurricane season, which runs through November 30th, peaking sharply between late August through the end of September. Some years are mild, to be sure, and we hope this is one, but other years have brought massive destruction in their wake. I'm thinking about the damage wrought in Houston from Hurricane Harvey and Puerto Rico from Hurricane Maria, Superstorm Sandy, which crippled the Northeast in 2012, and of course Katrina, which devastated states along the Gulf Coast in 2005. Even here in Windham in the Catskills, memories are still fresh about Tropical Storm Irene, which sent a 10-foot wall of water down Main Street in 2011, sweeping away homes and businesses and shuttering the local economy for the better part of a year. And the scars from that storm are still all around us. Before everyone started talking about pandemics, everyone talked about the weather. And they still will, again, soon. And today, we're going to get a head start. Joining us inside the Ice House are Chris Hartshorn, Chief Commercial Officer of risQ, and Lynn Martin, President of ICE Data Services, to talk about the growing relationship between climate risk and the U.S. municipal bond market. That's right after this.
It's more than an iconic building or a global financial marketplace. It's anywhere technology, commerce, and people intersect. The innovation that makes people's lives better. Dreams that were once impossible are now realities. At the New York Stock Exchange, we help tech companies flourish and change the world. So go ahead, bring those ideas to life. We'll bring it to market. We are Living Tech.
Today, for the first time, we have two guests joining us on one remote podcast. Gathering with me via Zoom are risQ's Chief Commercial Officer, Chris Hartshorn, and ICE Data Services President, Lynn Martin. So, a serial entrepreneur, Chris is the co-founder of Level 11 Analytics, and he joined risQ as an advisor in 2018, following a long career founding and working with some of the leading technology firms in the world. After earning his PhD in chemistry from the University of Canterbury, Chris began his career at UNC Chapel Hill and as a senior scientist for the U.S. Navy Research Lab before joining GE. That's NYSE ticker symbol GE, where he held several roles managing technology programs. Lynn should be familiar to our audience. She is the president and chief operating officer of ICE Data Services and our guest on episode 70 of this podcast, where we discussed her role overseeing ICE's market data, analytics, and connectivity businesses. Together, these businesses are the cornerstone of ICE's strategy to provide enhanced trading, valuation, and data services to customers around the world. Lynn joined ICE as part of the company's acquisition of NYSE Euronext, where she was CEO of NYSE Life US. Chris, Lynn, welcome inside the Ice House.
Great to be here.
Thanks for having us, Josh.
So, Chris, let's start with you. Tell us where you are now and how you're managing through this time of self-quarantine.
I live about a 1 minute's walk outside the financial district of Boston, which means self-distancing isn't a big problem right now. The only thing you've got to dodge when you're walking your dog through the financial district is the tumbleweeds, making the best of life, doing the best to isolate and self-quarantine when I can. Boston's
my home. I saw forlorn pictures of a beautiful green Fenway Park, but no baseball players, no sound of the bat and ball.
Indeed. It's a shame. We will come back.
We will come back indeed. Lynn, you and I still see each other regularly through the computer screen, but how has your team at ICE Data Services transitioned to a remote environment?
And I enjoy seeing you on that computer screen very frequently, Josh. As you know better than anyone, Josh, given the fact that ICE really runs a network of trading and clearing businesses around the globe, which are systemically important businesses, such as the New York Stock Exchange, business continuity preparedness is always the front of mind for us. The thing that we have prided ourselves on is to really stay close to our customers. That's one thing that's always been at the cornerstone of our strategy, is to do things in partnership with customers. And I actually think that we've been able to have even more customer contact because of the technology that we employ, because of Zoom, like we're chatting on right now, because of WebEx, because of all of the proliferation of technology systems. I've been able to engage with senior level contacts at our customer base, our global customer base, regularly. I can have a senior level meeting in Asia and a senior level meeting in EMEA and a senior level meeting in America, all on the same day. So in some respects, I think we've actually developed closer relationships with our customers.
You were having pretty close relationships with your customers the last time we spoke, was late 2018. But since then, so much has already changed. How has ICE Data Services evolved since then? I guess you've had the acquisition of firms like TMC Bonds and other expanded offerings.
Yeah, and the acquisition of the TMC bond platform and BondPoint execution services as part of our trading businesses has really been part of the strategic pivot that we had already started the last time you and I spoke, Josh, and that is towards one of developing more tools for the front office and analytics for the front office. As you know better than anyone, we've always traditionally been a middle to back office data vendor. The old IDC business that we acquired in 2015 certainly played in that area. But as a result of the acquisition of those businesses, we had already had a very laser-focused directive to create tools and services for the front office, and that has only been enhanced through those acquisitions. Certainly another pivot that we've made since we last spoke, Josh, is really the focus on ESG. It's undeniable that ESG is at the forefront of investors' minds. In March, for example, you actually saw money coming into ESG-weighted funds. That's very different than some of the outflows you saw on your traditional equity funds. So even in a time of crisis, ESG was at the forefront of customers' minds, and we are excited that we've launched some new services like we're going to talk about today around that.
Yeah, one of the partners, of course, as part of this initiative is risQ. Chris, I'm wondering first, when someone looks on their calendar and they say, I've got Chris coming in from risQ, and they see it spelled RISQ, they must sort of wonder aloud, like, how should I pronounce this company and why is that Q there instead of a K?
We get that a lot. It's turned into a bit of an icebreaker for us, quite frankly.
Yeah.
Where there's almost a little bit of an ask and see as to, well, where did that come from, or what's it about, and how do I say it, and all the rest. So yeah, it actually turns into, I guess, a more of a lighthearted moment. We don't get too wrapped around that axle, but the Q, we're all about quantifying. So one of the big challenges of climate risk, what we're about to talk, what we're going to talk about for the next half hour or so, all about quantifying. And if you can't measure it, you can't do anything about it. You can't act upon it. So we're all about quantifying risk as opposed to making it squishy and unactionable.
So the idea for risk started with a graduate student's dissertation in 2014. Walk us through the original idea for the company and how creating a database, quantifying that, divided the country into 100 square yard segments and measured and assessed the climate risk for each of those segments, how that, from that initial effort, evolved into the business that we see today.
As with any startup, it's a long and winding journey, right? So the original work that came out of Northeastern University, the graduate student, that was Evan Kodra, who's now risQ's CEO, that was a really high quality piece of work that looked at all the different climate change models that were out there and basically built a best-in-class model of models for climate change. So it took the shortcomings of each one, stripped them out, took the strengths of each of those, put them in, and that was really the underlying intellectual property that came out of the university. So then the journey you go on, yeah, that's great, and the science is awesome, but who cares? Not just who cares, but who'll pay, which is always the key thing for a startup company. So from there, the company was actually founded in 2016 after a couple of years hiatus. And I'd say the subsequent 4 years between then and now has really been a journey of the science of what's possible and then the art of what's needed, and slowly converging those two circles to when your Venn diagram drops you into a point where the art that we built is this high-resolution catastrophe model for the United States, and the need that is there for the folks that are left holding the financial bag for the longest. And in a lot of ways, they represent securities with 5, 10, even longer maturity times on those bonds. So that's kind of where we ended up, where we are today. There were pit stops in the insurance space. Didn't really get a lot of traction there. They care about climate change, but they can change their premiums every 12 months. Whereas a municipal bond, it is what it is for the lifetime of that bond, and there's really no escaping it for the participants in that unless they have quantified information that says, yeah, you know what, this one's not looking so good anymore. Let's move on. So that's kind of where we ended up today. It was, I would not say it was a direct linear path. It was and it was far from a random walk experiment, but provided there's a quality customer discovery that goes on, you can always bring high quality technology to high quality solutions that people actually want and that people will buy.
So Chris, I own a drone. I send it up 500 feet in the air. I see 100 meter increments, stretching maybe a half mile in either direction, but call me a little skeptical around doing this for the entire United States. How exactly does it work?
Yeah, well, this comes back to the idea of having a great team of great data scientists. So we use machine learning, proprietary machine learning technology. And what that allows us to do is to take any data set that we find across the entirety of the United States, whether it comes in at county resolution, city resolution, census tract, satellite imagery, it doesn't matter what granularity that information comes in at. Through a machine learning technique called asymmetric modeling, we can take all of those data sets, we can overlay them with each other, we can build correlations and inferences between every single observation and every single piece of data. And then as a result of building and identifying those correlations, we can spit all of that same information back out at that 100 meter resolution level. So if you want to know the number of over 65-year-old affluent people with private health insurance who are obese living in a given area, I don't know why you would want to do that, but sure, we can do it. Same thing with property types. We've got satellite imagery of the property maps. We can overlay that with global human settlement layers. We can put that together with American Community Survey information. We can tie that to origin destination employment statistics, so we know where a given person lives and where a given person works in space. So by building in and connecting all of these really different pieces of data, and by connecting them up and mapping them on top of each other, there's a tremendous amount of insight and understanding that you can pull out that simply no one else has. And I haven't even talked about the climate piece yet. Oh, that's just understanding the US economy, the US socioeconomics, and the US demographics at high resolution. From there, we build out a wildfire model with the US Forest Service, an inland flooding model with another partner. We roll those same models at that same 100-meter resolution. So it essentially becomes that map, super high resolution understanding of how the United States works, super high resolution map of understanding how climate perils will impact those same areas. And I present you the ability to do basically anything we want, provided that unit area is 100 meters of size and greater.
The science of what's possible to the art of what's needed. Lynn, what's the art of what's needed? What's the real world application for the extensive climate risk database, and how did risk and ICE data services come together to collaborate on it?
That's a great question, because you hear Chris talk, it's obviously a very compelling data set that they have created. But in our mind, when we were thinking about the ESG demand in the market, the one thing we kept thinking was, how do we make something that's actionable? How do we make something that adds transparency to markets that someone can actually use to make informed risk management decisions? If you look at municipalities in general, you look at the state of California. When you think of California, what do you think of? You think of, prior to the pandemic, you thought of wildfires, because they had an awful lot of wildfire risk. And what's really interesting about the data set that Risk has developed, because they have essentially a 100-meter grid, you're able to marry that data set from a wildfire risk perspective alongside the broad database that we've created, valuing over 1 million municipal securities in the United States, and also offering terms and conditions data, so coupons, maturities, things of that nature. And when you start to line up those two data sets, you see that two different municipalities, one has wildfire risk, one doesn't, but yet they are priced the same in the market. Why is that? Well, it's probably because no one was able to bring that data set, those two data sets, really together in a way that just adds transparency. I mean, Josh, you mentioned in your opening remarks about hurricanes. We are on the verge of hurricane season. Some of the catastrophe metrics that Risk identifies are hurricane wind speed, tidal flooding, coastal flooding, inland flooding, those types of risks, for lack of a better description. And you look at a state like Florida, who's continuously issuing debt, who has hospitals that are along the coast. It's really interesting to see, when you look at, from a risk perspective, these different factors alongside, well, what are these two municipal bond pricing in the market? And what are their terms and conditions? And where do I have longer term risk and shorter term risk? So that's really what drove us to have the conversation. I think ultimately we were introduced by some mutual acquaintances in the industry who were really starting to think through, well, how do you quantify this stuff? They quantified the actual risks. How do you turn that into an actionable data set that someone can use to make an informed risk management decision?
Chris, I'm interested in what drove you into this line of work. You've got a PhD in chemistry and a background of working for companies involved in science and technology. Can you tell us how you came to Risk and what your role is there now?
Yeah, chemistry feels like a long time ago. I actually call myself a reformed chemist. It's been 15 years since my last experiment. The journey that sort of I've been personally on since then, so 15 years in the information services space, understanding what subscription-based businesses look and feel like, in that case, delivering them to large multinationals who are interested in data, interested in information, interested in actioning that information with respect to their innovation platforms. So that's where I kind of got started in this whole information services game. While I was there, helping grow that company as an executive there, Evan Kodra, the CEO of Risk, was part of an acquisition that we made. So Evan and I began working at that point, working on some interesting stuff that was more innovation focused, and worked together really well. We went our separate ways for a while. We did our separate things. I went back to New Zealand. I spent some time there running as the Chief Technology Officer of the New Zealand Government's Innovation Agency. But I had about, 30, 40 data scientists who were reporting to me at that time, building out data science solutions for the companies that underpin New Zealand's economy. So again, it was kind of a reinforcement of the idea that data and analytics is critical for action, is critical for decisions. I came back to Boston again, even reached out, said, hey, look, Chris, we've worked great together, looking for some direction for a company. Can you help me out a little bit? So I basically did some advising. Loved the idea of working with Evan because, always look for two things, right? Are the people great? And is the mission what you can jump out of bed for? And if you can tick those boxes, a lot of the other things that might get in the way kind of melt away a little bit. And from there, it became a question of advising the company, uncovering this opportunity in the municipal bond space, which came as a result of, I'd say, the work that I was doing to help Evan out, to give it some direction. And then at that point, there was a decision as to, well, do you just advise and get other people to do the hard work, or do you actually put your money where your mouth is? And Lord knows I've got at least a mouth. It was time to commit. And I thought, this is the sort of thing I could really get in behind. And that's where it took me into the chief commercial officer role there, where essentially the job is everything. It's not technical. I know when I'm out of my depth, we've got some people that do zeros and ones in every way, shape and form, some of the best I've ever come across in all of my journeys. And those journeys are getting pretty substantial now, not to age myself. And if I can handle all of the business development, the product market strategy, the partnerships, the licenses, all of that good stuff that really makes a business sing, and help these guys just build great products. That's easy to do. Just sign me out for that 7 days a week and twice on Sunday, and we're all good.
Thinking about that journey you've been on and what comes out of your mouth, we certainly hear the Kiwi accent there. I'm sure, Chris, you are our first New Zealander on the podcast. Honored because of that. I read in National Geographic a few days ago that New Zealand has effectively eliminated coronavirus. And just today, your Prime Minister, Jacinda Ardern, joined Australia's coronavirus cabinet meeting to discuss reopening trans-Tasman travel, effectively forming a travel bubble down there. Has New Zealand's approach to managing its climate influenced your views around climate science and the need for applying it to real-life applications?
I'm not sure as much as it's influenced as it's if it's just the nature of where you grow up and how you grow up. I mean, I'm not sure where the influence would come from. I guess it's a whole nature versus nurture thing, right? That I would say that New Zealand as kind of a nation has a pretty good collective view. There's generally a view as to not privatizing profits and socializing costs. I think there's a much more balanced view there, and you can see that in the way that New Zealand responds to crises, whether it be the current pandemic, whether it be to other unfortunate events that have struck New Zealand, earthquakes. There's been unfortunately the mass shooting there. The country's response to crises, part of the social fabric of the individual and of the collective. So if that has come across in some of the views that sort of the ways that I see the world personally, I would not be surprised, not by any means. It makes it easy to get out of bed. And so chalk up 4.5 million New Zealanders who think exactly the same way, and product of your upbringing.
Lynn, you've been in cities for a long time. So let's talk a little bit about municipal bonds, the $3.8 trillion market for funding state, local governments, airports, schools, hospitals. It faces a test this month as New York City's transit agency offers bonds to the market for the first time since the coronavirus emptied its subways, trains, and buses. So ICE Data Services has one of the most extensive business offerings for data analytics and trading for the muni bond market. Can you tell us more about ICE's offering in this space?
Comes back to a bit of what I was saying earlier. We had a very strong base when we started the ICE Data Services journey of end-of-day pricing in the muni markets, which I think we've only made stronger over the last couple of years through some various acquisitions and investments we've put on the platform. But we've also made the pivot from not just being an end-of-day provider, also doing intraday, but more recently real-time prices, as well as continuing to build out the terms and conditions. Having that kind of base data offering, you can do a lot of really interesting and neat things alongside it to add value. Great example of that are some of the analytics we've more recently rolled out. And in the last 2 months, in the height of the volatility in the muni markets, we rolled out things like our municipal real-time curves offering, available on a screen that a trader can just watch to see what is going on in the muni market, the full AAA curve. And you'd be unsurprised to know that it's been quite a wild ride over the last 6 to 8 weeks while we've been in this pandemic situation. When you have that type of information, you can also build a really strong index business. We've got a variety of muni indices that many folks benchmark products against. So now, in our mind, this is just another extension of how to better service the muni market from a more fulsome perspective. How do we continue to add data sets and analytics that allow the muni market to, number one, have additional transparency around it? Quite an opaque market. I think only 10 to 15% of that market even trades electronically. But there's the opportunity. There's the opportunity for a data vendor in particular. The more transparency you add to a market, the more items that allow customers to manage risk, the more liquid a market becomes at the end of the day. So the way we think about our muni offering is just a holistic data services offering, encompassing every part of the risk management spectrum.
And then just to get a little more granular, how exactly did the vision for ICE climate risk come about?
It was really the marrying of what we were hearing as demand from market participants for ESG-driven metrics. I've said the words ESG a couple of times. For the listeners who don't 100% know what that means, E, environmental, S, social, G, for governance. The environmental side, prior to the pandemic, and probably continuing after the pandemic, was the one that the minute you said ESG, folks immediately went to. What's my greenhouse gas emission score? What are the environmental factors on a company? And a lot of times you think about that from an equities perspective. What's the carbon footprint of a company? Do they buy offsetting carbon emissions? It's even more interesting, though, when you look at the fixed income markets, given the proliferation of securities. We talked about the muni markets having over 1 million securities. Just think about that. The US equity markets, I think, only have about 5,000 to 6,000 publicly listed companies. So it's an order of magnitude and an order of complexity that when you're looking at developing an offering around ESG, the one thing you need to be very laser focused on is creating things that are actionable. Creating data sets for the sake of creating data sets, while may be interesting, you won't get the broad market adoption. You won't be serving a need in the market. So when we started looking at the ESG demands in the market, started inventorying our own data sets. And then, as I mentioned earlier, a mutual colleague introduced us to Chris and Evan at Risk. It was just a conversation that made an awful lot of sense.
Just bolting on top of that really quick. I mean, we'd already been engaged with a lot of the community, the bond community, for probably about 12 months, even before the conversation with Lynn and the team at ICE started. And one of the things we were hearing was, yeah, guys, this is great, and we know we can use this information. One of the things that I think is going to be really bring it to life and make it really actionable would be if you can take all this information and tie it to the securities. So we were getting direct feedback from the users that were very much engaged with us to say, yeah, you know what, this is really good. The piece that you really need is this last piece, this last connection. And so it was exactly what we were hearing from the market as well. And that's where the introduction that we got to Lynn and the team was perfectly timed. They were the perfect round peg for the perfectly round hole that we were getting from the customers that we were talking to.
Round pegs and round holes. After the break, Chris, Lynn, and I are going to continue our conversation on the importance of climate risk to the municipal bond market. That's right after this.
Advancements are coming. Equity and fixed income ETFs are poised for continued growth. And ICE ETF Hub is ready to advance the ETF industry. Simple, efficient, transparent. Get involved.
Before the break, Chris, Lynn, and I were talking about the original idea for risk and ICE Data Services partnering to create ICE Credit Risk. Let's bring the conversation back to today, both of you, and the current environment we're living in. COVID-19 has been a big focus for everyone for the last couple of months and has impacted the daily lives of people around the world. At a time like this, when we're grappling with a global pandemic, why should we care about the climate risk of municipal bond issuers right now?
Well, I think if anything, the current situation we're living in showing what can happen when very quickly in financial markets, what can happen when jurisdictions are not prepared for potential outcomes, when there is not foresight into sort of every eventuality and how they can play through to social systems, to financial systems, to systems of resiliency. I think there's a lot of parallels between what we're experiencing now and the level of preparedness and the complexity of response to what one can potentially see if you start playing it forward into climate events as well. I think there are some very logical parallels that one could make between the two on that basis.
So, Lynn, currently, muni bonds come from, I guess, over 50,000 issuers and constitute well over 1 million separate securities. What are some of the themes, patterns, rules of thumb that you use as starting points to look at this market? Give me some of the basics to help us start to think about the muni bond market.
It's a very opaque market. And one of the things as the chair of the Muni Transparency Subcommittee of the SEC's FIMSAC committee, that has become incredibly apparent to me is just knowing what is available to trade. When you think about 1 million securities, you can't underestimate just having a catalog of what is even available and what the differences are. And it starts to get quite confusing, especially since you mentioned yourself, Josh, some of the big issuers in the market, like the MTA in New York City. State of California is another big issuer. The Transportation Authority down in DC is as well. You start to look at those and it could be a little bit like bond soup in some respects, because there's just issues all over the place, different durations, different coupons, different amount outstanding, served for different purposes, different issue dates, things of that nature. So just getting that staple of data in a digestible form is no mean feat. It's no small undertaking for a firm. And then when you actually think about trying to ascribe value to those, as well as the relative liquidity, a view of the relative liquidity of each of those bonds, that's another large area that we spend a lot of time thinking about. So when you marry those three elements in particular, you can sort of form a view of, well, I may want this exposure, I may want this sector, but I may not want this liquidity profile. I may want something more liquid or less liquid. Sort of depends on what your investment thesis is and your outlook for the future. So you kind of need to approach this market just from a series of building blocks more than anything, given its complexity and widespread nature, before you really start to understand it. And that's why I'm so excited about this project. To me, this is a building block. When you start to think about, particularly in some of the states that I mentioned, you think about a state like Florida, you think about California, think about North Carolina, you think about coastal exposures. You mentioned Texas and the effects that they had from hurricanes, Louisiana, New Orleans, who could forget Katrina. You know, you start to see some of those natural disasters, Puerto Rico in particular. You start to think about some of the natural disasters in history, and you can definitely see different patterns forming about why bonds were priced a certain way at issue and things of that nature. So to me, this is just another building block of the market, of a unique market that just needs to be better understood by market participants.
Some criticality that you layer on top of that as well in the present environment. So we know that the balance sheets of a lot of issuers across the country are incredibly stretched right now, whether it be states, counties, cities, hospitals, you name it. You can go through every single cohort of the issuing community and find financial distress as a result of the current economic environment. We're going into the spring inland flooding season in the middle of the country, up and down the Mississippi Valley and the Missouri Valley. how are they going to handle financially and logistically if a major flood comes through some of those jurisdictions? We're projecting a 30 to 40% more severe hurricane season this year. What will the state of local finances be up and down the eastern seaboard and the Gulf Coast area if a hurricane comes through, given how stretched finances are of the country, of the states, and of those individual issuers? There's just a tremendous amount of vulnerability that's been layered into the system that climate events can now kind of double whammy on top of. And so there's even more reason now, given all those fundamentals Lynn talked through, to be aware of what the climate risk is, because there has been no time ever when climate risk could have a greater impact on the municipal bond sector, given its current state of vulnerability.
Yeah, and Chris actually raises a good point, just to go back to a question you asked earlier about why we should be concerned about climate factors in this sector. Hospitals. You think you turn the TV on every day, and what is the first story? How are your hospitals stretched? Think about New York City. We had hospitals in Central Park pop up. The Javits Center was used as a hospital. If you get a hurricane on top of that, do you know what that's going to do to an already taxed system? So when you start to look at the hospital sector of the municipal environment, you may want to look at, well, does this also have hurricane risk in addition to the trends that I've been seeing on TV? Because that may be a foreshadowing of additional cataclysmic stress being put on certain regions.
I mean, both of you, especially as you were talking, Chris, giving me a case of post-traumatic stress. In a prior career, I used to work in the insurance industry, first at the Hartford, that's NYSE ticker symbol HIG, and later at Willis Group, which was formerly WSG, now been subsumed by Towers Watson and then Aon. You were talking about earlier days at risk, talking to the insurance industry. You look at a graph in a white paper that Risk published on climate risk as a tool for municipal bond stakeholders, and you see this startling and widening gap over time between insured losses, those things that all of the policyholders have that are covered, fire, wind, and uninsured losses, water, flood. It really drives home how current and future climate risk is an existential threat to the municipal debt ecosystem. The majority of economic climate losses are now absorbed in some form by the public sector. A flood comes through a city, like Superstorm Sandy inundating the New York subway system, and it really is a new definition of Schitt's Creek. So how does Risk's mission help all stakeholders in the market understand both current and future climate risk in a way that's operationally and strategically relevant?
Clearly, the fact that the insurance industry is managing to mitigate some of their risks means that they're obviously passing that risk on to the financial market. So that was very, and you captured that incredibly eloquently. But what that means is the public purse that's represented at either at the federal level, the state level, the city level, or it's down to the individual taxpayer. And all of those things underpin the credit quality for the given issuers that are actually there. How does an investor in this space, how does a participant in the financial sector that's looking at muni bonds then figure out, well, exactly how impaired will any of these issuers be when a climate event rolls through? Essentially, we've got to do exactly what the insurance industry did, which was build a catastrophe model, which allowed them to mitigate for all of that climate risk that they were exposed to before Hurricane Andrew in 1992, and provide exactly the same tools, the same type of catastrophe modeling sensibilities, except applied to the issuers of municipal bonds, so that now participants in that space can be just as informed and take just as high quality and informed action as the insurance industry has taken, which has allowed them to generate that insurance gap that you mentioned, Josh. We're, in a sense, trying to even the playing field, allow the municipal bond sector to be informed and have the same tools at their hands as the insurance industry has been building for the last 25 years, and allow them to make those decisions and move forward on that basis.
Do you expect that this new data you're providing, which could highlight areas where higher levels of climate risk exist, could actually negatively impact the borrowing capabilities of some of these communities?
There is the potential for that to happen. So certainly the first step in addressing a problem is recognizing and admitting that there is a problem. And again, if you can't measure it, then you can't improve it, you can't control it. So our job is to first measure, to get the dialogue and the disclosure of potential climate risk for the bond issuers to be levelized and everyone looking at the same information and having an honest and open discussion about it, and then figuring out, well, okay, what are the next steps that we should take in order to mitigate this risk? A lot of the wealth management entities in the buy side that we've been talking to, they say, look, we accept there's going to be some climate risk in some places. We'll even invest in that if we believe that the issuer of that debt is aware, if they're taking action, if they're talking about it, then we're willing to put a bet on them because, again, they've gotten past that first step of, do we have a problem or not? Are we aware of the problem? Then at that point, there's a bunch of solutions. There can be bonds that they'll invest in that will build the infrastructure that provide that resiliency, sustainable finance operations and some large financial services sector companies where they'll invest off their own balance sheet into some of these projects. So they're willing to be informed, and then they're willing to provide the investment for the issuers of debt who are willing to act and are willing to engage in the discussion. If someone on the other hand, or if an issuer on the other hand is ostriching up, head in the sand, not aware, not willing to act, they're putting their own residents and the people inside their own jurisdiction at risk. And that there should be, in some way, shape or form, a dialogue around that. And there should probably be some action taken on that. And if that comes down to money and becoming more expensive for them, that's an unfortunate artifact, but it's the one way you can drive adaptation. It's the one way you can drive resiliency, is if there's a price to pay for not engaging in it.
I think there'll still be continued capacity for these municipalities to go and issue debt. I don't think that's going to be the issue. I think potentially price may diverge, but again, that's not for us to say. We're not taking risks in the market. We're not issuing debt in the market. That's up to the market to decide as to whether or not, now that you know pieces of information, should I price in that risk or should I not price in that risk?
I mean, thinking about maybe the last 10 weeks or so, climate and viral threats are so very different, but is there any data that you've been able to produce from the COVID response which provides new insight into how climate is affecting infrastructure? Only
to the degree where the connectivity between impact on the population, so in terms of employment, in terms of GDP, in terms of the inability for transit authorities to generate revenue, for all of these types of things, you start seeing the flow through direct to the top and then to the bottom line of a lot of the entities that are responsible for this debt that's on the market. The lessons that can be learned from that is, well, how quickly can this systemic issue play through into these markets? I've seen some analogies that this COVID-19, it's like a hurricane hits the entirety of the United States, and this is the recovery from that. Obviously, that's not going to happen from an actual climate perspective, but isolate that down to a place that is vulnerable to hurricanes, vulnerable to floods, vulnerable to wildfires, and you've got a much more, I would say, surgical and destructive force, because not only then is it the people and the economy that's impacted, it's actually the infrastructure that's impacted on top of that. So you've got an extra axis of damage that then needs to be repaired and recovered from. So I think there are plenty of analogies there, but the main one is, look, if you've got enough of a systemic problem that hits you in a consistent enough way, eventually something's going to break. And we need to be prepared for that. And to be prepared, again, you've got to be informed.
Flip side of the lockdown, There's been a lot of discussion in the media about the rapid drop in emissions due to the reduction of economic activity. The International Energy Agency last week issued a report that said global greenhouse gas emissions are on track to plunge nearly 8% this year, the largest drop ever recorded, as worldwide lockdowns to fight the coronavirus have triggered an unprecedented decline in the use of fossil fuels. Is it possible to know if these few months will have a significant or noticeable impact on how climate risk is modeled?
Only if it continues on a sustained basis. So one of the biggest challenges of recognizing the climate change problem, it is a slow-moving, long lag impact, right? So the decisions we made 10 years ago on carbon, we are harvesting those decisions right now, and so on and so forth, right? The only way it really impacts climate models and the likely climate outcomes in the out years from now is if this is a sea change in terms of ongoing behavior. I'm skeptical that that's the case. And I'm also a little bit hesitant to tie a victory on climate to a pandemic, right? Because the last thing I think we need is to have the association between an 8% reduction in carbon emissions with unprecedented spikes in unemployment, right? It actually doesn't present a great story that, well, if you want to reduce carbon emissions by 8%, first you must swallow your 20% unemployment, right? It's kind of a bad message. And it's a false message because there are plenty of ways to go through climate transition. There are plenty of ways to undertake climate adaptation that don't require an unemployment penalty, don't require a GDP penalty, require no financial penalty whatsoever. In fact, quite the opposite. So I'm actually a little bit hesitant to hitch the wagon to that horse too tightly.
So, Lynn, as we wrap up, we saw an announcement that Breckenridge Capital Partners signed on as the first client recently for this offering. What attracted them to it, and what's been the reception from other firms that you've been speaking to in the market?
So Breckenridge was one of our first customers that did sign up for the service. They were actually using, as I understand, another provider initially, and then they saw the specificity of risQ's offering, found that to be much more of a precise data set that they could use for risk management purposes. The reason why they signed up with us, though, was because how we brought it all together, how we brought together on a security by security basis, marrying with the risk data. When you think about it, you take those two data sets together, and while it probably makes a lot of sense and probably makes sense for the folks listening on to today's podcast, that's a lot of work to do for a firm who's got a lot of other priorities. So the fact that we can bundle that type of information together on a security by security basis takes a lot of the work that the customers need to do out of the equation. It becomes very plug and play for them. Additionally, something else that we've heard from customers is not just the themes I mentioned earlier, but also the fact that we're doing this through our native distribution mechanism. We've got relationships with more than 5,000 customers, individual firms globally. They're already ingesting information from us. So they can just ingest this information in a format that is already plugged into their infrastructure, that is already plumbed into the key risk systems on their side. It's a very digestible form of information that just gives them an additional layer of transparency. But make no mistake, it is very much because of the fact that it's a very specific data set that risQ has developed that allows us to marry our security by security information alongside theirs to make it actionable.
So we've taken a little tour around the world and specifically around the United States over the last half hour or so. We've touched on hurricanes, flood, tornado, wildfire. I'm not sure if we hit any other risks, but when you're looking at the risk database, some things that a casual observer might not know about, what other areas of negative climate risk factors might make you worried or might surprise any of us that they exist, that they would factor into a muni bond?
Oh, the headline events are always the hurricanes and the wildfires, right? And for obvious reasons. I'm not trying to be blasé about it. I think the most underappreciated and underestimated part of the climate risk that's out there is actually the inland flooding side. And we see this in a lot of the people that we talk to and provide our information to, where they're constantly looking at California for wildfire, and they talk about Florida for hurricanes, and they do all this good stuff, right? But a lot of the biggest climate risk that's out there is up and down the middle of the country. And there are substantial changes because of these climate events where population decreases over 10 years that we can correlate to the quantity of inland flooding, losses of property value that we can correlate to the quantity of inland flooding. If you think about population and property value, these are two of the key indicators of the future financial health of a given issuer, of a given jurisdiction. And inland flooding has been a massive component of that. And again, there aren't that many movies about slow-moving inland floods. Plenty out there about wildfires and all the rest. So that's probably the one thing I think surprises everyone is just how impactful some of those events are when they're not on the front pages of your global newspapers.
So both of you, give us a little peek into the crystal ball. What is next for climate change data and for risk?
So for us, we've got this super high resolution, high credibility map of the United States. There's plenty of economic value that we can go ahead and characterize on top of municipal bonds. So mortgage-backed securities, real estate investment trusts, essentially anything that exists in terrestrial space in the United States has climate risk associated with it. It is climate risk that can be characterized. And generally speaking, that climate risk and that asset is traded in some way, shape, or form on some sort of financial market. Mission and our vision is based to a march and inform and drive climate adaptation across the entirety of the financial services sector with respect to the United States.
Yeah, I think there's definitely applications for the broader fixed income markets. Mortgages is certainly, I'd say, the next low-hanging fruit. When you look at property value and things of that nature, think about, Josh, in your past life as working for an insurance company, how incredibly valuable this type of information could be when you're looking at underwriting someone's property insurance. So not to mention the mortgage-backed securities market, as Chris mentioned. So I think there's much broader applications for this data. We wanted to get the muni markets one out to the market first, but we have had dialogue about other applications as well.
Well, with that, I think I'm going to head outside, send the drone up about 300, 400 feet into the sky, see if I can map out a few 100-meter increments around my place in the Catskills, and I will let you guys get back to your work. Thanks so much, Chris and Lynn, for joining us inside the Ice House.
Thank you, Josh.
Thanks, Josh.
That is our conversation for this week. Our guest was Chris Hartshorn, Chief Commercial Officer of Risk, and Lynn Martin, President of ICE Data Services. If you like what you heard, please rate us on iTunes so other folks know where to find us. And if you've got a comment or a question you'd like one of our experts to tackle on a future show, email us at icehouse@theice.com or tweet at us at IceHousePodcast. Our show is produced by Damon Level and Pete Ash with production assistance from Stephen Romanchik and Ian Wolfe. I'm Josh King, signing off from the library of the New York Stock Exchange, the remote branch here in the Catskills. Thanks for listening. Talk to you next week.
Information contained in this podcast was obtained in part from publicly available sources and not independently verified. Neither ICE nor its affiliates make any representations or warranties, express or implied, as to the accuracy or completeness of the information and do not sponsor, approve, or endorse any of the content herein, all of which is presented solely for informational and educational purposes. Nothing herein constitutes an offer to sell, a solicitation of an offer to buy any security, or a recommendation of any security or trading practice. Some portions of the preceding conversation may have been edited for the purpose of length or clarity.